What's up, everybody? KOHL'S, one of my largest holdings, just reported earnings this morning. The stock is up in the pre-market. They definitely beat a lot of people's expectations. I won't go into my full thesis here. I've made a number of videos on KOHL'S. If you search KOHL'S on my channel, you are sure to find them. This is a company that owns billions of dollars in real estate and land. They are significantly cash flow positive, and they are basically being priced by the market as if they're going bankrupt and dying. For me, I thought KOHL'S was a mediocre, low-quality business that still, looking at the numbers, I thought was going to be a great investment because it just got simply too cheap. If you get value out of the video, subscribe to the channel. Now let's jump into these earnings. We'll start with the statement from their interim CEO. The CEO spot at KOHL'S has basically been a revolving door. We've had Michelle Gass as CEO. Kingsbury was the CEO for the last few years. He was replaced by Ashley Buchanan, this guy right here. He was CEO only for a few months, the first quarter of this year. He was fired after basically siphoning off money to his girlfriend. So right now we have interim CEO Michael Bender. And he says, KOHL'S second quarter performance is a testament to the progress we are making against our 2025 initiatives. This resulted in sales performance that came in ahead of expectations. These initiatives are resonating with customers. Our team remains focused on delivering progressive improvement throughout the remainder of the year against a challenging economic backdrop. Now, keep in mind, KOHL'S sales are down year over year. There's very few companies that can have a revenue down and say, yes, sales performance, that came in ahead of expectations. It's just that the sentiment around this company, the expectations that were there were for pretty much a complete disaster. And that's not what we're getting. He continues, in addition to the top line progress, we managed the business with great discipline in the quarter. We were able to expand our gross margin, reduce our inventory, lower our expenses, leading to solid second quarter earnings. That's a pretty good summary. They did a good job tightening up the ship as far as expenses are concerned. Now, I'm just going to go and jump towards the numbers so we can see what he's talking about. So sales were down 5%, but they also closed some stores. Typically for a retailer, you want to look at comparable sales, and they were down 4%, which is basically the top end of their range. They were saying 4 to 6% decline. Some analysts were saying 5 to 7. And while revenue is down, margins are up. Gross margin up by 25 basis points. They're selling more of their proprietary brands. We'll talk about that in a moment. All of their corporate overhead expenses are down. They're more efficient at managing this business. That's what we want to see. And the bottom line, adjusted operating income of $161 million, adjusted earnings per share of 56 cents in this quarter. Now, one quick note on the word adjusted. Whenever you read adjusted anything, you got to look up what that adjustment is. Companies can do a lot of funny things with adjustments. When you read operating income, there are rules about what is considered operating income. These rules are GAAP, generally accepted accounting principles. But whenever you see a metric that starts with adjusted, there are no rules. They don't have to follow US GAAP when they report adjusted anything, adjusted net income, adjusted free cash flow, adjusted operating income. That doesn't mean adjusted metrics are bad or that the company is doing something shady. With many companies, when they report adjusted numbers, they're trying to back out one-time events. They're trying to make it more clear what's going on with the business. But, sometimes in those adjustments, you see all sorts of things. And a rule of thumb, if you just want to look to see, is the company doing something weird with adjustments? Go through their past statements and see, are their adjustments always inflating their income? Are the adjustments always making the company look better? It's a red flag if a company's adjusted operating income is always coming in reasonably higher than their GAAP operating income. That's a sign they might be doing something funny. Now, in KOHL'S case, KOHL'S adjustments are very reasonable. They had a gain on a legal settlement in this quarter. KOHL'S, like many other retailers, were suing Visa, MasterCard, and a bunch of banks for basically colluding on their interchange fees, being naughty and price fixing on those credit card fees. The retailers won. KOHL'S is realizing a gain here from that legal settlement, but this is just a one-time gain. So what are they doing? They're subtracting out that gain from their GAAP operating income. That's exactly what they should do. So their reported operating income was about $280 million, but after their adjustments, they're down to $161 million. So in KOHL'S case, their adjustments are really just helping us better understand what's going on with the company. Earnings per share is similar. The reported earnings per share, $1.35 here, which sounds, oh my God, absolutely massive. $1.35 in earnings per share for KOHL'S for this quarter. But once you adjust for the legal settlement, net of the tax implication of that, you're down to 56 in earnings per share. This is a significant beat on the bottom line. Essentially, in spite of the top line being down, because they've improved their efficiency, they've improved their margins, the bottom line has remained flat. And just from a cash point of view, which for a retailer, cash can be very lumpy, it bounces around a bunch. They have to manage inventory, they have to buy that before they can sell it. So cash flow can vary a lot quarter to quarter. But thus far this year, first 2 quarters, operating cash flow, $500 million. Subtract out CapEx, you're looking at free cash flow of about $300 million so far. They are still making money. The cash flow for this business is still pretty strong, especially when you compare it to the price that you're actually paying here. They always have a huge depreciation expense because they own a ton of stores. So that lowers their earnings, but it doesn't affect the cash flow of the business. Now, getting into what's going on with their products, they pretty much completed the rollout of Sephora. Almost all Kohl's stores have a Sephora inside. This means we can likely expect CapEx to come down a bit. And they say improve performance in women's as we invest back into our proprietary brands. Proprietary brands, these are the products that you can find only at Kohl's. So they either own the brand outright or they have some exclusive license like with, Lauren Conrad or with Vera Wong's line. This is their thing that they can say, you can't get this at Macy's or Target or wherever. They make higher margins on these products. And, a lot of times they're not even more expensive to the consumer. These can be at some pretty good price points. They just make higher margins because they control more of the chain. Under Kingsbury, who was CEO for the last few years, they de-emphasized their proprietary brands. They were more focused on, establishing partnerships with big national brands, the Nikes. Now they're focusing more on the proprietary brands and they're seeing results. Proprietary brands outperformed the company in Q2, showing 500 basis points of progressive improvement from Q1. That's great to hear. They are improving their product mix. The decrease in sales is coming mostly from these large national brands. Sales are actually up in proprietary brands. This is also what's helping improve their margins. Gross margins are up. One of the things they cite is increased proprietary brand penetration. Now, getting to their outlook, their guidance for the full year, they have upped this. They're saying full year comparable sales down 4 to 5%. Now, I want to compare all these numbers with what they were saying in the first quarter. They were saying comparable sales for the full year down 4 to 6%. So they've narrowed their range there. And honestly, I think the management is setting themselves up to be able to outperform these numbers again. Adjusted operating margin, I'll just call this operating margin. Kohl's adjustments, very fair. They're guiding for 2.5 to 2.7%. Previously, they were saying 2.2 to 2.6. And on the bottom line, earnings per share, 50 to 80 cents, compared to before, they were saying, essentially nothing to 60 cents. Overall, if I had to just give a one-line summary of Kohl's, it would be not as bad as you think. That's the story here with this company and this stock. Now, one more thing I want to look at here really quick is their debt. They had a big payment that was coming due in 2025. They've rolled that out to 2030. So looking at their maturities on their 10K here, these payments here for 2025, they have now paid these off, and they've added a $500 million maturity that's coming due in the year 2030. So no significant debt for 5 years. This company has time. It's also nice to see that in the bond markets, pretty much all of Kohl's bonds have been rallying over the past few months. I'm just looking at their 2031 bonds here, but the story is similar across the rest of their debt. The bond prices are up, the yield is down, and what that means is the bond market is pricing in less default risk today in Kohl's debt than they were a few months ago. Now, the yield is still high. This is not high quality debt by any means, but this is an improvement. Now, let's get into the market's reaction to all of this. We're still in the pre-market here. Stock is up quite a lot, but Kohl's is a very volatile stock. The short interest is still extremely high. When the market opens, this could move either way. Just to give you an example of the crazy price action that this company has, looking at the trading yesterday, we were up to, about $14 a share. And then less than 30 minutes before the close, the stock dropped down to the low 12s. This was about a 15% intraday move on what? There was a Bloomberg story that came out about 30 minutes before market close saying Kohl's seeks more time to pay vendors during turnaround effort. Essentially, the headline implies that Kohl's is having a problem with their cash position. They're reporting on news that is months old. Kohl's is updating their payments. They have quicker payment time to vendors than a lot of their peers like Macy's and Dillard's. They're trying to get vendor payments more in line with a lot of comparable companies in the sector. So just very weird timing for a story like this to come out 30 minutes before market closes, right before earnings. In any case, the market sold off quite a bit, bounced back, and now it looks like it's going to open significantly up from where it was trading yesterday. So as far as what I'm going to do here, again, the market hasn't opened yet, but I'm probably not going to do much. Depending on where the stock trades today, I might sell some covered calls on my position. The premiums on options here are very high. I wouldn't mind being paid to wait. Kohl's is a low quality business that probably as of market open will be the largest holding in my portfolio. I don't imagine I'll be holding this stock long term. I just bought in because I thought the price got absurdly cheap when it was down here. My cost basis is a little over $8 a share. I still think it looks undervalued at current prices, but with a low quality company, I'm not going to wait until the company gets to fair value to start trimming my position. I've said before, I would likely trim at $20 a share. That's where I'm selling a lot of my covered calls at. Could I miss out on greater upside? Yes, that of course is the trade-off of selling a covered call. I did a video on options before. If you want to look on my channel, search options, you'll find it. I just don't want Kohl's to be too massive a position in my portfolio. And now it looks like I've stalled long enough so that markets have opened. Kohl's has opened at about $16 and change. Again, this is going to bounce around an absolutely massive amount. Maybe it will be higher. Maybe it will be way lower by the time you watch this. I don't know. But if you got value out of this video, subscribe to the channel. If you agree or disagree with anything I said, leave that down in the comments below. And I hope to see you all in another video.